Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Brian Stutland, managing partner at Equity Armor Investments, and David Townsend, head of product marketing at Halo Investing. They join us to discuss decoding the market, macro sectors, and we'll also learn about using structured notes as a tool to derive income. It is great to see the both of you as always. Brian, let's debate this for a moment here. Are stocks in free fall, or is it just some profit taking, or perhaps the start of a new bear market?
Well, it feels a little bear marketish. When you look at basically the last 10 trading days or so, any sort of sell-off has seen a little bit of a rally, but that rally has fizzled out below the previous high. So we're getting higher low or lower highs, I should say. And that's been fueling this bear market feel. It's almost feeling like a 2022 scenario where we are seeing, some speak about, hey, interest rates aren't going to get cut. And maybe now we need to reassess where valuations are in the market overall.
Right. And David, do you agree with Brian's assessment that potentially we could be heading into a new bear market?
Well, certainly there's always fears of the bear, but I still think that there's significant tailwinds that I just could see us shaking this off, getting over this wall of worry. It's always a concern, but I just see some more tailwinds down the stretch here. Obviously, what's happening in the Middle East, there's a considerable global macro issues, the interest rate uncertainties, but I just have a feeling at the end of the day that some of this could be shaken off.
Right. Well, we're still really early in terms of earnings season as well. And, a lot of the companies that have been leading the way start to report over the next couple of weeks. So I think that's also going to help drive the narrative as well. Let's go back to interest rates for a moment here. Are higher interest rates based on what the 2-year note is now indicating? Is that what repricing the market?
That really has been a repricing, Jill. I mean, when you look at it ticking back towards 5% here on the 2-year, that's basically saying, well, we're maybe not going to get interest rate cuts, not just for this year, but maybe not for the next couple of years. And, I thought it was kind of interesting here, actually. I took a look at what the Federal Reserve governors, a lot of talk this entire month, and that's really kind of driven the market slightly lower here. And when you look at it, you've had a really mixed results on whether a Fed governor believes we should be cutting interest rates, raising interest rates, or where we stand. And it's kind of interesting that when you look at it, Powell sits sort of right in the middle of everybody. Bullseye, I kind of highlighted here in the circle. He's kind of said we're in the right place right now with interest rates. Obviously CPI numbers ticking up a little bit. That's a little bit of a concern. And the Powell basically saying, let's get more data and a wait and see kind of game before we can take it interest rates lower. I think a lot of people, on the sideline basically we're expecting 3 rate cuts, but you look at this sort of chart layout and we're probably going to be no cuts. If anything, let's hope data doesn't get worse, because then we might have inflation and drive interest rates higher.
Right. Well, but Brian, let's think about it from this perspective. Insurance cost has been a really big component in terms of why costs are so much higher for the consumer. My home insurance went up 25% in 1 year. That it's a little bit shocking. That's hard to digest. I don't see how Powell cutting rates by 25, 50, 75 bips is going to alleviate, 20 to 25% increases in auto insurance, home insurance.
No, it's not. And that's why I think when you look at some of these numbers of where inflation is coming, it's almost a reflation that's going on. You have a very strong economy, GDP still on the rise, and prices going up, really where it's hitting people the hardest in the economy. And so even though you're seeing this expansion of GDP, it's not really being felt for the average, middle America here, because like you talked about, so many of those areas seeing inflation come back. And so I'm more in the camp that we need to hike, if anything, not cut, not stand still, and maybe get still ahead of this.
Yeah, Brian, it's interesting. We had a conversation in December. You probably don't remember it, but I asked you, this is hard for me to admit. Brian is a Michigan Wolverine. I am an Ohio State Buckeye, so it has been a terrible, hard year, and it's hard for me to give credit where credit is due. But Brian and I spoke in December, and I asked him, what is the one thing people aren't seeing for 2024? What's that unknown? And he told me rates aren't going lower in 2024. I don't know what he had up his sleeve, but it's certainly coming to fruition, your prediction of several months back.
Yeah, our Michigan guys, we've been dead spot on over
Yeah,
the
you've had
last
a good
few
run
months.
of
Yeah.
good luck.
Is this a Big Ten panel? You have Rutgers over here, so
I noticed, yeah. So
we should rebrand this a Big Ten panel. So David, the question is, where are traders hiding out? Is gold an area to invest in if investors are looking at risk off? Has that trade run too far? Are they still going there because of inflation concerns?
yeah, interesting. Like gold, I think of it as two things. You got the inflation or the speculative part of it, right? Like, and I know everybody's quickly racing to revise their estimates higher for year end, but at Halo, we tend to think of it. We deal in protective investments, so to me, it's an inflationary. I'm sorry, an insurance type of scenario where it's protective in nature. So from a portfolio, I would probably be including it less for speculative purposes, more for insurance purposes. And the way I like to describe it is literally like the only, even though the real return longer term over the last like century is like 1%, it's still the most effective tail hedge out there, and you're earning some level of return. So insurance wise, you should probably be adding some gold right now.
Yeah.
Yeah, and
Brian,
I would say, I mean, when you look at adding gold in here, and let's just look at some of these numbers, you look at the CPI and where it's going. And Jill, you talked about some of the numbers on the rise. It has shifted, right? We saw this deflationary environment heading into 2023 where things were maybe coming under control, and now it's ticked back up. So once we've seen that reflation, typically, historically, when we get that uptick, there's been that hideout, to David's point, insurance kind of component to it. The insurance play has been get into gold when you see sort of this inflation kind of environment rehappening again.
yeah. Well, what is the VIX signaling? Clearly, it's had a substantial move from a perspective on a percentage basis over the past couple of weeks. We know as the VIX is trading lower, those moves feel more exaggerated, kind of almost takes the elevator up versus the stairs down when you're looking at the volatility markets. When you're analyzing it from a technical perspective, what are the levels indicating to you?
Well, volatility has been coming down over the last, call it, year and a half. We got the Ukraine-Russia situation that sort of freaked people out. Obviously, any sort of systemic war kind of thing, like we're now seeing with Iran and Israel, that's obviously led to some volatility. If you had a VIX overnight, that certainly spiked. When I was watching options, I was up all throughout the night watching to see what was going on and see where that would take the market and volatility. But it is interesting that the VIX continues to make lower highs. And I think it's interesting. I kind of highlight right here some levels. I think 18 is really a key level here in the VIX, because you look the last couple of times, we got these spikes. We got concern about systemic risk and volatility, sort of a ripple effect throughout the rest of the economy. But then the VIX made a lower high as the market was sort of sitting near bottoms and sort of kind of petered out and head lower. So I think we're, 18, if I see the VIX fall below 18, I probably want to get more bullish. And to the top of the point of the show, David, saying, hey, this might be just a temporary sell-off. I see the VIX drop, doesn't make a new high here, kind of falls back below the 18 level. That's probably a buy signal for the market and people wanting to take their insurance risk off.
Mm-hmm. And David, let's switch gears for a moment here and talk about structured notes. What are they? How can investors use them? Is there anything while investing with structured notes that you can, discern macro trends from?
Yeah, and picking up on the VIX thing is one thing that the phones have been ringing off the hook. It's obviously volatility spiked recently, and you can get indicative pricing on our platform on structured products. The thing about with VIX though is that the spot and the forward, it's based on the forward curve. So that's the one. It's a common question: is, hey, VIX is going higher. What can we benefit from this, or how do we do it? So in terms of notes, it's actually, forward looking. You go to like VIXCentral.com and you can see that forward curve. But in terms of notes, no doubt with just uncertainty sort of ticking up more recently, folks are looking at notes for our structured products just in a couple of ways. You could be if you're bearish or you're bullish, there's a structured product can be customized to you either which way.
Right. So let's talk about these a little bit more granularly. Structured notes as another way to invest. What is an income note and how are advisors using them today in both in practice, and what type of income notes are most popular?
Yeah, well, I don't want to get our compliance folks freaked out if I gave you a specific note type, but I can tell you catapult notes are probably a popular one right now. And but backing up a step, essentially what a income note is it just linked to an equity index or some other index, an underlier, and you get a coupon that can be customized monthly, quarterly, however you want. You can add memory to it. So you can just think of it as a bond with a bunch of different fancy kickers to it. Now, what's interesting is obviously for those in the know in terms of structured notes is that as rates have ticked higher, yields are much better on these things, and they're better than what you can get available on, say, a lot of high income type products. And back to the catapult note, what's interesting about it is that obviously because of notes are usually subject to sort of a call provision. Even with an early call, you're getting the coupon alone is above what is the historical average return of the S&P 500. So if advisors like these things because you can get a decent little return there. And even if it's not called, it catapults to an even higher participation rate. So it kind of acts like an income note or digital note more specifically. It converts into a growth note. So advisors are using it simply because the rates have moved higher.
Brian, are there other opportunities to use notes to get exposure to the stock market?
I think there is actually, just to tie things up with volatility and the VIX and how people use structured notes. As volatility moves higher, the VIX moves higher, the yield, the component that you can get for some of these notes moves higher and tied with that. And so it's very interesting for an investment advisor. The way I look at it is I'll look at it as opportunistic. When I see a VIX spike, I'll find some notes. Typically, I like using, David talked about index linked type stuff, but I actually like looking at things that involve individual stocks, staples, a Coca-Cola, McDonald's, names like those, where I know those stocks are going to be here for a while. They don't have big downturns when the economy turns down or the market turns down. They kind of tend to hang in there. And I can give them a little bit of a protection play, add some yield by doing an income type note, and then, pick up better yield than I would in a high yield product or some other fixed income area. I can collect a little bit more and risk less because I've shifted my protection to a lower level in the stock market where I'm willing to buy these stocks.
All right. And let's go back to earnings for a moment here. Of course, the AI trade is really what's in focus. When you think about companies like a Microsoft, like Google, Brian, what is the options activity around names like this that have been part of the AI trade?
Yeah, I mean, AI has obviously been big, and next week is going to be big on earnings. We have Google earnings, we have Microsoft earnings next week, late next week. That's going to probably be a market mover because we've gotten this big sell-off in the market. There'll probably be a little bit of a pause here, see where some of this earnings picture comes out to see if we can get the market back higher again and exceeding some of these expectations. But to the option trades here, I think it's interesting. I kind of want to highlight something here where you can kind of look at open interest next week on some of these things and really see what's going on. Let's just take a look right here. Give me a second to fast forward. Yeah. And so on here, when you're looking at open interest here, if you look at Google and Microsoft, what you find here is that there is some heavy open interest to the upside, is particularly the call side activity of things, and not so much on the put side. Really, when you look at Google, huge open interest on this 160 strike, very big open interest in Microsoft on the $425 call strike. And when you get this huge open interest, these guys have skews where it's to the upside. So this area of big open interest sort of acts as a reflector off of that. So I expect if Microsoft or Google report really well and can get above these strikes where there's big open interest, the stock could be off to the running to the upside. If we miss a little bit, I expect the stock really to move away from these strikes to the downside. So you're going to get some pretty big movement. Look at these strikes because you're going to get some movement away from that after these names report.
Mm-hmm. And finally, David, a quick take here on investing in the AI trade now and using growth structured notes to do so.
Yeah. Funny you mentioned it because just last week, Frank Manilin, who heads up our trading desk, came by and said, "Man, you and Equity Armor, you guys were talking about AI plays a year and a half ago. Somewhere there's a bunch of folks that are pretty happy about this." I went back and looked what we were talking about. We did Adobe, Microsoft, and Google. It had 207% participation with a 40% barrier. So obviously, all of those, that's a worst of, but even at the worst of, they've all more than doubled in price in that time. So no doubt investors like structured products to tap into these names, add a level of for uncertainty to the downside, but can have a level of participation. It's above and beyond what is already high octane.
All right. I appreciate the insight as always, guys. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.